Welcome to the CFA Level 1 presentation on understanding the balance sheet. In this presentation, we will first provide an overview where we will talk about components and format of the balance sheet. We'll then talk about current versus non-current assets and liabilities, measurement basis, footnotes. Then we'll talk about different kinds of assets, current and non-current, as well as dealing with financial assets. We'll then move on to liabilities and equity. After a brief overview of different kinds of liabilities, we will talk about different types of equity, and specifically we will cover exactly what minority interest means and other comprehensive income means in the context of equity. This presentation will be concluded with an overview of ratio analysis using the balance sheet. The balance sheet discloses what an entity owns and owes at a specific point in time. It is also referred to as the statement of financial position. The financial position of an entity is described in terms of assets, liabilities, and equity. So this statement over here at a specific point in time can be contrasted with the income statement. So as you just saw in the previous lecture, income statement will tell you the picture of a company over a given period, such as the year 2010, and the balance sheet will be a snapshot on a particular day, such as 31st December 2010. So the balance sheet will tell you what the assets are on that day, what the liabilities are, and what the equity is on this day. So balance sheet is like a snapshot. The components of the balance sheet: assets, liabilities, and equity. So assets are resources controlled by the company as a result of past events and from which economic benefits are expected to flow to the entity. So anything from which the company expects some benefit in the future is called an asset, and typical assets on a balance sheet would be cash and cash equivalents, inventory, trade and other receivables. Sometimes you see this referred to as accounts receivable, prepaid expenses, financial assets, property, plant and equipment, investment property, intangible assets, assets held for sale, and we will be talking about these in a lot more detail during this course. Liabilities represent obligations of a company arising from past events, the settlements of which are expected to result in an outflow of economic benefits from the entity. So essentially any obligations, any future obligations are written as liabilities. Typical liabilities disclosed on the balance sheet are bank borrowings, notes payable, trade and other payables, provisions, unearned revenues, financial liabilities, accrued liabilities, and deferred tax liabilities. Here again, don't worry if you don't understand terms like deferred tax liabilities and so on. We will see these in detail later. Equity is determined by subtracting the liabilities from the assets of a company, commonly known as shareholders' equity or owner's equity. So equity basically is the total assets of the firm minus the liabilities gives us equity. You'll notice throughout this reading that, or actually throughout this topic on financial reporting and analysis, that there's a lot of detail on defining assets. There is detail on defining liabilities in terms of how to measure them and so on. Equity then is simply the difference between the two. So there is not too much detail on measuring equity, because equity is just what remains when we do assets minus liabilities. The format of the balance sheet. The balance sheet should distinguish between major categories of assets and liabilities. Two common formats: a report format and an account format. In a report format, all the components, the different kinds of assets and then liabilities are listed in a single column. So you will have all your assets and then liabilities and then equity. In an account format, this is more traditional. We basically follow general ledger accounts with assets on the left and liabilities and equities at the right of a central dividing line. So many of us have seen this: assets on the left, liabilities and equity on the right. A classified balance sheet groups together similar items to arrive at significant subtotal. So for example, you might have cash, inventory, accounts receivable. All these are grouped together and a subtotal for current assets. Then property, plant and equipment. All the property, plant and equipment is summed together and we have a subtotal, and so on. So this would be a classified balance sheet. Current assets are assets which can be converted into cash or used up in 1 year or one operating cycle. An operating cycle could be longer than a year for a airplane manufacturer, for example. And what we mean by an operating cycle is the time from which we buy raw material to the time that we collect cash, or till the time that we sell. So this is our operating cycle. Current liabilities are obligations which will be settled in 1 year or one operating cycle. Excess of current assets over current liabilities is called working capital. So working capital is simply our current assets minus current liabilities. High working capital means that we have a lot of current assets, a lot of money tied up in our current assets relative to our immediate obligations, and this would imply an inefficient use of funds. Low working capital would mean potential liquidity problems. Now how high is high and how low is low really depends on the industry you are operating in, and to determine whether a given company has high working capital, we need to compare the working capital with other firms in the same industry. More on this later. Non-current assets are assets which are not converted into cash or used up within 1 year or one operating cycle. Non-current liabilities are obligations which are not settled in 1 year or one operating cycle. IFRS requires non-current / current format unless a liquidity based presentation is more relevant. The exception applies: all assets and liabilities shall be presented broadly in order of liquidity. So this means that whenever we present a balance sheet, the typical way of presenting it is to show our current assets versus fixed or long-term assets separately, and then current liabilities and long-term liabilities separately. So in general, this is what's required. The exception is for, say, the banking industry. For a bank, rather than showing assets and liabilities in terms of current versus non-current, it makes more sense to simply show the assets and liabilities in terms of liquidity, where you can start with the most liquid and go down to the most illiquid, or the other way around, but basically organize your assets and liabilities by liquidity. Measurement basis. Balance sheet contains a mixture of fair value costs and historical costs. With fair value, the amount at which an asset can be bought or sold, or a liability can be settled. So a classic example would be land. Let's say that you bought land 10 years ago for $1 million, and the market value of that now is $4 million. So the question is, should you show land at the historical cost of 1 million or the current fair value of 4 million? If you were to buy that land or sell that land today, it would go for 4 million. So If we say that land is being shown on the balance sheet at fair value, it means that we are showing land at 4 million. If we say that the asset is being shown at historical cost, then that implies that we are showing it at the cost at which it was purchased. So historical cost is the value that was exchanged at the acquisition date. In limited circumstances, current costs and present value are also used, where current cost is the cost to replace an asset and present value represents the discounted value of future cash flows. So as mentioned, this is in limited circumstances. The two main types of measurement bases that you need to be aware of are fair value and historical cost. As we study assets and liabilities in more detail through this entire topic, we will define whether an asset needs to be shown on fair value or historical cost. Notes to financial statements are integral parts of both US GAAP and IFRS reporting. Now, rather than reading through this, I'll just let you know that whenever you look at, say, a balance sheet, in the balance sheet you will see assets such as inventory, property, plant and equipment and so on. So in your balance sheet there will simply be a number associated with assets such as inventory, property, plant and equipment, as well as your liabilities such as short-term debt and so on. But associated with each item there will be a footnote, and these footnotes provide a lot of detail on this number. So if inventory is 100, this footnote will give details on that inventory, as well as whether inventory is being measured on a first in, first out basis, last in, first out basis. We'll see this information in more detail later, but the core point is that the details associated with items on the balance sheet are shown in the footnotes. And hence, for an analyst to truly understand the financial picture of a company, it is absolutely essential to study the footnotes in a lot of detail. Current assets we've already talked about, but what are the typical current assets? The typical current assets are shown on the slide, and they are cash and cash equivalents, marketable securities. So these might be financial assets such as stocks, bonds, etc., accounts receivable, inventories, and other current assets such as prepaid expenses and so on. But these four types of current assets you need to be very, very familiar with. Inventory, so what we are going to talk about now is some of the major current assets. So one current asset is inventory. Inventory is measured at lower of cost or net realizable value. What this means is, let's say that you bought inventory for $10, and then let's say that the value of the inventory in the market went up. So the net realizable value is how much you could sell the inventory for. Let's say you can sell it for 15 minus the cost to make that sale possible. Let's say that's $1. So the net realizable value will be 14. On your balance sheet, inventory needs to be shown at $10 because that is the lower of cost or net realizable value. Cost is 10, net realizable value is 14. So you need to show the inventory on your balance sheet at $10. Now let's say that for some reason the market price or the amount at which you can sell this comes down to $9. The cost to sell is still 1, so the net realizable value is now 8. If this is the case, then now on your balance sheet you have to show inventory at 8. So that's what this statement means. Alternative techniques can only be used if resulting valuation approximates cost. So some organizations use a method called standard costing, where we assign a predetermined cost to goods produced, or a retail method where we simply say cost is equal to the retail selling price minus some standardized gross margin. So as mentioned, this technique can only be used, or these potential techniques can only be used if resulting valuation approximates the actual cost. There is a whole reading on inventory later on, so we will study this in more detail later. Tangible assets are long-term assets with physical substance and are hence called tangible assets. Sometimes these are also called fixed assets. They are reported in the balance sheet at historical cost less accumulated depreciation. So historical cost is the original cost that you paid for, let's say, a given piece of equipment, and all cost necessary to get the asset ready for use. So if you paid 10 million for a large piece of equipment and another 1 million to install it and set it up, this will be shown on your balance sheet initially at 11 million. And then every year you depreciate. Let's say that this asset will last 11 years and will have zero value at the end of 11 years. You will depreciate 1 million every year, assuming the straight line method. We'll talk about depreciation and fixed assets again in a lot more detail later. But just to give you an idea, at the end of year 1, if we've depreciated 1 million, then we will show the asset, the book value of the asset will be 10 million. 2 years later, the book value of the asset will be further reduced by 1 million down to 9 million, and so on. Land typically is not depreciated because it is classified as an investment asset. Intangible assets are acquired singly, and rights or privileges have finite benefit periods. So with intangible assets we have two types: identifiable and unidentifiable. Identifiable assets are acquired singly, and rights or privileges have finite benefit period. So what exactly does this mean? When you acquire a new patent or a copyright or a trademark, you might pay, say, 5 million for a new patent, and this might be valid for 5 years. So you clearly identify that you are buying XYZ patent, you know how much you are paying for it, and that patent has a certain useful life. So this would be an example of an identifiable intangible asset. These assets are amortized over the useful life. Amortization is exactly like depreciation, except it is applied to intangible assets. If you are amortizing 1 million every year, then after 1 million this asset will be worth 4 million, after 2 years it will be worth 3 million, and so on. So with unidentifiable assets, the asset is not acquired singly, and the rights benefits would not have a finite period. A classic example is goodwill. So when you buy a company, goodwill is the excess of purchase price over the fair value of identifiable assets and liabilities. So if the fair value of identifiable assets and liabilities is 10 million and you pay 12 million for a business, then the goodwill is 12 million minus 10 million, which is 2 million. Now notice that that 2 million worth of goodwill you cannot buy separately. So to get that goodwill, you need to pay the entire 12 million for the business. And since it's not identifiable, it cannot be amortized. However, periodically, and this would be at least a year, you need to test for impairment. You need to check whether that extra 2 million that you paid for goodwill, whether that still holds. And this will be covered in detail when we do the reading on long-lived assets. For intangible assets that are purchased, we use historical cost less amortization. For intangible assets that are developed internally, so you, for example, develop a patent internally, the legal costs can be capitalized. So let's say you spend 1 million on legal fees. So that is the fee given to lawyers, the fee for registration, etc., to register this patent. That can be shown as an asset. According to US GAAP, all other expenses related to this patent have to be expensed. So if you spend $3 million on this patent, other than the legal fee, this 3 million has to be shown as an expense in the income statement for the year where this patent was being developed. According to IFRS, any research related work that you do for this patent can be or should be expensed, whereas development costs, so actually building prototypes related to this patent or development work, this can be capitalized. Again, more detail on this later. Under both US GAAP and IFRS, some expenses must be expensed. When we say expensed over here, again this distinction between expensing and capitalizing we will see in detail later, but very briefly, by expense we mean we show it in the income statement for a given year. So any training costs, startup costs, administrative costs, advertising, relocation, etc. So all these costs must be expensed, which means they must be shown as expenses in the income statement. Financial instruments. Financial instruments are found both on asset and liability side of the balance sheet. When we talk about a financial asset, this includes investment securities such as stocks and bonds, derivatives, loans, receivables, etc. Financial liabilities include derivatives, notes payable, bonds payable. Derivatives, which we will talk about in detail when we cover derivatives, are instruments whose values are based on some underlying factor. And just understand this terminology for now. Mark to market is the process whereby the value of most trading assets and liabilities are adjusted to current fair value. So let's say that you bought a stock for $10 and today that stock trades at $11. So on your balance sheet, that asset needs to be shown at $11, and this process of showing the price or showing a value equal to current market price is called marking to market or mark to market. Marketable investment securities are classified as either held to maturity, trading securities, and available for sale. This is important, and essentially what this means is, say you buy a corporate bond. That bond would either be classified as held to maturity, trading, or available for sale. How you classify depends on your intention. If you buy a security such as a bond where you intend to hold the bond till maturity, then you will classify this as held to maturity or HTM. If you plan to sell this when the price is right, so you are simply waiting for interest rates to go down so the price of the bond goes up and then you plan to sell it, or if you own shares which you will sell when the market goes up, then these would classify as trading securities. And if you are not sure, or you don't plan to trade immediately but you plan to sell at some point before the security reaches maturity, then classify it as available for sale or AFS. Now, how do we deal with these securities on the balance sheet and income statement? As already mentioned, there are three possible classifications. So let's say that you buy a bond, and if the bond is classified as a trading security, then on the balance sheet it must be shown at fair value. So if you bought the bond for 100 and it's now trading at 95, on the balance sheet you need to show it at 95. Any dividends, in this case, since it's a bond, you will be receiving interest. Had you purchased a stock, then you would be recording dividends. But let's say that this is a 5% bond, which means you get $5 every year. So that $5 needs to be shown on the income statement as interest income. You need to show any realized as well as unrealized gains and losses. So in this case, let's say that the price went down, but you did not sell the bond yet. So $5 is unrealized gain. Unrealized gains and losses are the gains and losses that happen which have not been realized. So this means that you've not sold the bond. Had you sold the bond, then the loss in this case would have been realized. The point being that for trading securities, even unrealized gains and losses are shown on the income statement. For trading securities, this other comprehensive income is not applicable. Had you classified the bond as available for sale, then on the balance sheet you would still show it at fair value. So in my example, you would show the bond at 95. Income, so the interest of $5 would be shown. And now here is the difference between AFS and trading. You only show realized gains and losses on the income statement. In this case, since we have not sold the bond, we did not have any realized loss, so there will be nothing over here. However, the unrealized gains and losses, which in our case is -5, will be shown under other comprehensive income. Now the third category is held to maturity. Here on the balance sheet you show your bond at amortized cost. We will understand this concept of amortized cost later when we deal with bonds and when we deal with fixed income securities. But for now, let's just say that this is approximately equal to historical cost. Say you bought the bond for 100, then with this held to maturity classification, the bond will be shown at 100 on your balance sheet. On the income statement, we show the interest and any realized gains and losses. Interest was $5. There is no realized gain or loss because we've not sold the bond, and that is it. Since we are planning to hold the bond to maturity, we do not record any unrealized gains and losses. Let's do this problem now. IFT Corporation purchases a 10% bond for $100,000 at the beginning of the year. Interest rates have recently increased and the market value of the bond has declined by $2,000. What is the impact on the financial statements under each classification? What I want you to do now is pause the video and fill in this table. Okay, welcome back. So if this is a trading security, this is the first classification, what do? On the balance sheet, recall, we need to show this at fair value. The bond was purchased for 100,000. The value has gone down by 2,000. So on the balance sheet, you need to show 98,000. On the income statement for a trading security, the first thing that we show is the interest income. 10% of 100,000 would be 10,000. Plus, since this is a trading security, we also need to show unrealized gains and losses. In this case, we have an unrealized loss of 2,000. So overall, we have an impact of 8,000 on the income statement. Other comprehensive income is not applicable over here. Had this bond been classified as available for sale or AFS, then again on the balance sheet we need to show this at fair value, which would be 98,000. On the income statement, remember, we show the interest, which is 10,000. We do not show unrealized gains and losses on the income statement. So overall impact on the income statement is to show an income of 10,000. However, that unrealized loss of 2,000 is shown under other comprehensive income. Had this bond been classified as held to maturity, on the balance sheet we show the historical cost, which is 100,000. On the income statement we show our interest income, which is 10,000, and since we plan to hold this till maturity, we show nothing. We do not even mention the unrealized loss. Liability